the lead lag report. Joining me there, Sofia Horta Costa. I hope I correctly pronounced the full name correctly there. Sofia, there's a lot I want to talk to you about, given some news overnight, but set the stage for the audience. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
You pronounced my name quite well, Michael. So well done you. Yeah, I'm Sofia Horta Costa. I am Portuguese. I'm currently in London. I'm just relocated here after 5.5 years in Hong Kong. I think most people follow me on Twitter for the China threads. I used to do weekly China news. Still very much have my eye on China, but since moving here, I've been covering a little bit more global news. I do focus a lot on the UK. I blog, I'm on TV, I do video, I do social. I ask a lot of questions. So Michael, be prepared for that. This won't be a one-way conversation. And I mean, today the focus was all on the US. So I think that's a market that I can't ignore either. But yeah, still very much interested in China.
Okay. And since you hit on it, I changed the name of the Twitter space to make it a little bit more dramatic. Shades of the summer crash of 2011, which, if you remember that time period, the S&P downgraded U.S. credit quality. You had a very aggressive reaction in the first week of August. Interesting parallel. Treasury yields actually fell back then. They're rising this time around, although obviously it's just the initial reaction. Lay out just maybe for the audience if there are any parallels aside from the fact that it's another downgrade happening at this time in the calendar year, and why this time may be actually different compared to what we saw back then.
Yeah, so I do think that the drama around 2011, that was a completely different market, Michael, wasn't it? I mean, the panic around then, 2011 was very much height of the European sovereign debt crisis, and also the impact that, a country like the US losing AAA rating, the impact that could have on markets was a lot bigger than, since then, so many countries have left that club as well. So it's not, I don't think it really packs the punch that it did back then. I do think what's interesting this time round, and I like that you said drama. I'm going to ask you about that after, if you do think there are a lot of people kind of saying that you add a bit too much drama perhaps to markets. I want your thinking on that. But I mean, this time round, it's coming at a really interesting time because markets were so kind of, everything is good news. It doesn't matter if it's, if it paints a worrying picture about the economy. Absolutely everything was taken as good news. We even had the UK inflation print at 7.9%, which is incredibly high. And yet everyone was celebrating because it was less than expected. So, I mean, the fact that this came after a spectacular July for risk assets, just before the BOE, which is tomorrow, which might kind of surprise markets again, and really kind of a reality check. I think the timing was incredibly interesting. Michael, what do you think? I mean, you said on Twitter earlier today that you're going to be really annoying today. Have you been annoying today? And why did you say that?
First of all, I'm always annoying, in fairness. And I do that as kind of a joke, as something I've been saying for a while. I've been very consistent on this idea that it's a pre-election year, which, I argued back in January would be a melt-up because generally pre-election years are the strongest of the presidential cycle, but that there will be a credit event looming because of the lagged effects of the fastest rate hike cycle in history. So I put that because, one, it gets engagement, and honestly, I think it's funny. I find a lot of people in our business are a little bit too strict and stern, and at the end of the day, if you don't laugh every now and then, everything we're doing is, I'd argue, largely meaningless because that's the true store of value. But to me, it's more of an issue of, are the conditions there for a tail event? Now, I'm actually not so convinced that the credit rating itself is. I keep going back to, which we should touch on. I do think there's a real risk with an unwind of the carry trade. But since you mentioned the BOE tomorrow, and you said they could surprise, what do you mean by that? What's gone for? Everyone has a home bias. Obviously, a lot of people here in the space are probably from the US, the West in general, but what's going on the Bank of England side?
Yeah, so it's quite funny when you talk about home bias, because a few weeks ago, so before the big kind of Fed, ECB and BOJ week, someone asked me on live TV, which central bank could be the most market moving? And I said the Fed, because the Fed is the Fed. And as you say, I mean, it's kind of the most influential. It sets the tone, right? And it was also the first one of the three. What ended up happening was actually the BOJ in Japan surprised markets because everyone thought that was a done deal. The BOJ tends to be the least shocking to markets, but it did shock. And it tweaked the YT policy in a very confusing way. I think markets were more confused than shocked, to be fair. For the BOE, so, I mean, this is interesting for me because I haven't actually covered the BOE since 2020, I was going to say 2011. God, no, since 2017, which was a very different dynamic. I mean, inflation at the time was 3% and people were saying that was high. And that's when Mark Carney was running the central bank. It's a very different case right now. So what happened was the inflation print that I talked about earlier in the UK at 7.9%, which is incredibly high. I think if you're listening in the US, you're probably thinking, whoa, how are people celebrating a print like that? It was lower. It's slowing faster than expected. So what's happened is the market is now pricing in a 25 basis point increase. But some people are warning that 50 basis point would make more sense. There's still a lot of work to be done on the inflation front. The BOE can't kind of lose face because it did hike 50 basis points at the last meeting. It needs to kind of carry on with this messaging that it will fight inflation as much as needed. But the markets don't quite buy that. So I think it does seem that people are kind of split between the two, but the market is very much banking on 25 basis points. So if we do get 50 basis points, Michael, I'll be tweeting about it tomorrow.
So you will be annoying as well.
I'll be annoying. I mean, I like to try to not be annoying, but yeah, I mean, I think people on Twitter don't like it when their views are invalidated, especially, if you're very much in the bullish camp or very much in the bearish camp. I mean, do you think you're bearish? Are you one of those perma bears, or are you kind of just trolling and trying to get a reaction on?
Far from it. Anybody that's tracked me, I used to be on CNBC and Bloomberg all the time. I was one of MarketWatch.com's top writers for a while. Anybody that just does any kind of casual look at research I put out can see that I play both sides because I don't believe it's about being a bull or a bear. I believe it's about conditions and flexibility. And I do deeply believe, though, that, and maybe this is sort of a contrarian element to the way that I approach the world, I do believe that when everybody is on the same side of the boat and everyone is then pushing back because of a counter argument, usually with insults, that typically tends to mean that you're at an inflection point. Now, I saw that in October of last year when I was screaming melt up. I saw that in December when I warned of an imminent crash, and it was the fifth worst December in history. I saw it at the start of the year, so on and so forth. So there is something, I think, behavioral to what you alluded to, which is that everybody wants confirmation bias. Social media, I think, encourages that through likes and retweets. But when it gets to be the point where there's a degree of overconfidence that the future is known by the crowd, my argument would be it's not about being bullish or bearish, but betting where the payout is highest. And the payout is usually highest when fewer other people are betting on a pot nobody's even thinking about that could pay off, right? So, and to me, it's ultimately about recency bias, right? To the extent that everyone's basically just trading yesterday, which, the truth is pretty much, I'd argue, everyone does, including central banks. That ends up being sort of a recipe for disaster. I'm curious, though, on the BOE, because I've written about this as well, at least on the lead lag report side, put this out. But is there something with the transmission mechanism of rates in England and in the UK where it's not as effective? It's not like it seems like the BOE is perhaps the most lagged outside of the BOJ when it comes to dealing with domestic inflation.
So you just mentioned my kind of key, if I'm to geek out on a financial market phrase right now, it will be transmission policy, monetary policy transmission mechanism. I mean, that's a problem, I think, for most central banks. The BOE one is quite quirky because, I mean, unlike the US where most mortgages are for 30 years, it's kind of similar here, but it's a much shorter mortgage market. It's 3 years, 5 years. But the fact is, yes, there is a lag. And also mortgages are priced on the swaps curve. So even when the BOE changes the interest rate mechanism, it doesn't kind of feed through. It's interest rate expectations that actually matter for mortgages. The other thing is a lot of people actually own their homes outright. So they would be impacted, obviously, by a rising mortgage rate environment. And also within that, excluding that, people don't really need to refinance quite yet. So there is a delay here. I don't think the delay, at least in the housing market, is anywhere near as dramatic as it is in the US. I mean, we were talking here on the desk earlier about how crazy it is that you can secure a 30-year mortgage rate in the US. I think most people in the UK would love to have that right now. But yes, it is, it is a problem for the BOE, but it's not unique to the BOE. I do have I do tend to look at things from the China perspective, just because I've been covering that part of the world for so long. And there, there's a huge policy transmission problem there on the kind of the other side of things, right? Because the central bank there is trying to prop up the economy. And it's doing that by, the only way it can, which is to cut interest rates. But credit is already incredibly cheap. And essentially, when you do stimulus and you focus on the supply side of things by making credit cheap, by making it easy for people to get mortgages, by essentially, what Beijing did this week, which is to open or increase the opening times of restaurants, for example, to get consumer spending. That's not going to fix the problem if you don't have demand. And that's really, from the China perspective, trying to increase demand, consumer demand for things, trying to improve sentiment. That's a lot more difficult to do. And you can't just kind of do that from the central bank. I think it's a really interesting problem for central banks, here where I am right now, China, where I was covering for the past 5.5 years. But you tell me, does the Fed have a monetary policy transmission problem?
I think they're probably the best of all of them, right? Just given the efficiency of the financial system compared to other countries and speed with which things happen. But I think the problem is less about the transmission, more about the perception around when the transmission actually matters, right? Which goes back to the delays. Although it's interesting, as I hear what you're saying about China, how much of that is just maybe more cultural than anything else, right? If you're going to lower rates, you want to try to increase consumer spending. Consumerism is, obviously very elevated in the US, but I get the sense that as a culture, China's not very big on that anyway. So is it a function of a transmission mechanism in China that's not working, or a function of just pushing on a string because the people themselves just don't like to go out and spend? It's more of a saving type of mentality.
I think, culturally, which one came first, right? The function of the Chinese economy essentially is that, first of all, private home ownership only really started in the 1990s. So a very different economy that we're talking about here. So, for a lot of people, owning a home was essentially their nest egg. There isn't really a kind of, there's definitely no welfare system like we have here in the UK. In the US, you wouldn't really be familiar with that, but it's also not a really pension. There isn't really a very developed pension market. So for most households, actually, their store of wealth is in property. And what's happened in the past 2 to 3 years is the property market has come down. That's been deliberate and engineered by China because there was a bubble there. Michael, a lot of people ask me, why is China doing this? Why are they kind of shooting themselves in the foot by collapsing their own property market? There's a reason for it. And because housing affordability was so ridiculous and people owned, not one home, not two, but three, it was very bubbly. So the difficult thing is, how do you kind of pop a bubble without engineering a crisis? And that's kind of where China is right now. So whether or not they'll do that successfully that's a whole nother conversation that we could have. But, for a Chinese household that essentially is seeing their pension pot dwindle in value, youth unemployment is incredibly high. It's at a record. It's more than 20%. The economic outlook is not great. And, residents went through 3 years of COVID zero. And COVID zero, I just really want to kind of hone in on how brutal that was. 40 million people who live in Shanghai could not leave their homes for 2 months. And people lost their jobs, really impactful on sentiment. So there is a kind of scarring that it runs a lot deeper, I think, than policymakers in Beijing had predicted, not just when it comes to the property market, but also all those tech jobs that were lost because of the crackdown on the tech sector and youth unemployment as well. So when you have that, are you really going to have consumers spending? I think there was a huge misunderstanding, especially I think from people in the US and from people here in Europe, that China's COVID reopening would result in the kind of consumer boom, just buy a bunch of things, revenge spending and all that we saw in developed markets. But that really did not happen. I even had an argument. I'm polite, so I don't, I have polite arguments, but I even had an argument with someone who said, China is going to be incredibly inflationary. China's reopening is going to be incredibly inflationary for the world. And this is very scary, but it's, the opposite is true. It's proven to be disinflationary for the world. And it's a really kind of strong force right now that we're seeing in producer prices coming down quite dramatically.
Which I'll say is actually an interesting plot twist, right? Because at the start of the year, that was the narrative. And that was one of the reasons people were still very bulled up on oil and commodities. And the reopening didn't have anywhere near the impact that everyone thought it did at the start of the year, to your point around that argument. But now we're seeing another resurgence in what could be coming cost push inflation from the commodity side. And it doesn't seem like it's really being driven so much from any kind of reacceleration in China. I want to revisit that. But the point about the unemployment, youth unemployment at 20%, how does that compare to history? How off is that relative to prior cycles for China?
So unfortunately, the data is nowhere near as good as it is in the US. So we don't have a huge data set, but it is at a record since records began, essentially. I would need to check, but I think it goes back to the early 2000s. So not a huge amount of history there, but it's incredibly, I really don't think we should underestimate the impact that's having, because, just on a pure consumption point of view, someone did a study on the proportion of spending by what we call youths. So that's from 16 to 25-year-olds. And it's a huge chunk of growth in consumer spending in China. So that immediately just feeds into weaker spending just on that front. But also, just think about it. Where are these young people living? They live at home. Their parents need to support them. Not only do their parents need to support them, but they also probably need to support their parents because of, that whole problem about there not being a welfare system, a pension system. Also culturally in China, it's quite normal and quite accepted for people to support their parents. So suddenly, one household, maybe two income earners, maybe two people work, are supporting, maybe even four parents and their children as well. So all that kind of income is divided between a lot more people. So it's really a drag on sentiment. And there's no really easy fix for it, because when you graduated in China, and China has really excellent and incredibly competitive universities, the best thing to do would be to go into China's Silicon Valley, so Shenzhen, and get hired by one of the big tech firms there. They've been firing, job losses they were bad for most of tech because everywhere in the world, all these tech companies just hired so much during the pandemic. But in China, it was a completely different story. It was not just a global downturn. It was also, Beijing's essentially saying, this is not the priority for us right now. We want to pivot to different industries that align with the Communist Party. So that's a problem. And even though we're really seeing a very dramatic change in tone and communication from Xi Jinping's government around these companies, now suddenly they're aligned with the Communist Party and they're key for China's future growth, according to the Politburo's latest statement. It's really hard to heal those scars, right? You don't want unemployment uncertainty. You want to pivot. You want to find a job that will be secure for more than 2 years. So I really think that there was a misunderstanding over how deep and how broad these scars were, if scars can be broad. Do you think, Michael, do you think people in the US still have a kind of negativity bias towards China? Or do you think that could shift and there could be a kind of re-engagement towards not just Chinese markets, but China generally? Because, I was in DC in October and in New York as well. And I just found everyone to be so hawkish on China and so incredibly negative and really not wanting to engage at all. Do you think that could shift, or is that shifting at all now?
So I'm cynical. To me, it always shifts when momentum is there because people just chase performance. The conversations that I have with financial advisors that I interact with is that almost nobody wants China in their portfolio. It's considered statement risk. In other words, the moment that an underlying separately managed account client sees a fund that has in the name China, it becomes almost a career risk for the advisor. So there is this perception, even if the advisors themselves might be bullish on China, the sort of mom and pop people that are their clients refuse to have it. So I do think it's more than just home bias there. I do think there's just an outright bias against China more generally. Now, again, I would argue that gets resolved if you end up having a period where those markets rise for a sustained period, because narrative follows price. Suddenly, China would be the most beloved investment play if it's suddenly outperforming U.S. markets. But I'm skeptical that would be sort of a prolonged momentum type of cycle. Because the other thing, of course, the background is, Taiwan, which maybe is a little bit of a transition. I wanted to ask you the question around the youth unemployment as sort of if that risks political instability. But I've had some people on these spaces that maybe you can say it's a conspiracy theory or not, would argue that historically, when you have high youth unemployment and a society which is down on itself economically, the answer to that tends to be war. That's not my view. That's other people's view. But I am curious to hear your thoughts on how that interaction may or may not exist when it comes to youth unemployment, economic activity being weak, and then China potentially doing a move with Taiwan.
I'm really interested in everyone's fascination with Taiwan. I mean, yes, from a kind of top-down view, and if you're looking at things in a really kind of broad historical context, not specifically at China, when a country is weak domestically, it tends to lash out. That's a very kind of accepted trend, as it were. But let me say this. From China's perspective, Taiwan is already part of China. So, I mean, this is all from China's perspective. It wouldn't need to invade a territory that's already part of China. So when we think about war would be China essentially sending military over to, that wouldn't make sense from a military strategically from a military point of view, unless they felt the need to defend it, which is why all the activity and all the rhetoric around whatever the US is doing in Taiwan tends to heat up, because that is seen as an act of aggression from an outside party. So China is incredibly patient. They think in decades. They don't have an election cycle, really different to the US, where you basically need to think about your voters every 2 years. I mean, even shorter, right? Every 18 months, you're thinking about an election cycle. China doesn't have elections. Xi Jinping just secured a third term. There is kind of no urgency to that. So you would think also China is now projecting itself as more friendly in kind of the diplomacy space. You saw Xi Jinping's government ministers, the new ones that were just announced either in October or a few months ago when the whole leadership was confirmed, meeting, Macron, meeting Germany, France, even there's even more dialogue with the US. So China really trying to get rid of the wolf warrior image that seemed to seep in during COVID, during the pandemic, when not only were its borders actually shut, but it also kind of closed itself in and looked inwards. Now, I do think from China's perspective, there is a softening in tone. There is no urgency to do something like that. The government does not need to appeal to votes or to distract the population. There hasn't actually been any social unrest from youth unemployment. There was social unrest around the housing market. That was really interesting. There were mortgage protests last summer where people essentially collectively decided to not pay their mortgages. But, there isn't kind of yet signs of really something building. I do think the risk is that people in the US, and when I say in the US, I say in DC, where I was, and I thought people were incredibly hawkish, overplay the risk of this, and that kind of just adds fuel to a fire that maybe wasn't there to start with.
Just to reset the room for the remaining minutes here, everybody please make sure you follow Sofia here on Twitter. If any of you want to, or X, I don't even know what to call this anymore. If any of you want to come up and ask questions, don't hesitate to click on that bottom left mic request button. And as always, this will be in podcast under Lead Lag Live on all of your favorite platforms, Spotify, Apple, as well as on YouTube in the days ahead. Okay, and I think also a part of this dynamic with China relates, and Taiwan relates to, for lack of a better way of saying it, chip wars, right? It's through the idea that Taiwan is a big driver of global chip manufacturing, and to the extent that AI mania continues to run wild, there becomes an interesting economic dynamic when it comes to the importance of Taiwan for both China, the US, and obviously the rest of the globe. What's gone on recently in terms of China artificial intelligence type of infrastructure and what they might be doing? Because I got to assume that dynamic becomes really a bigger and bigger force in terms of how US and China interact with each other.
Yeah, and it's really interesting to see how everyone's kind of rushing to be competitive on this front. The US has undoubtedly an advantage there. It's really ahead of the game. China, I mean, one of the biggest companies involved in this is Baidu, and they have announced an AI, kind of their own AI technology, but it's kind of, it has teething issues. The fact that China's access to certain US technologies and even European technologies has been cut off by policymakers in Washington, that's obviously not helping things. And the fact that China essentially needs to start from scratch because, well, when it comes to the most advanced chip making capabilities, because it was so reliant on, and it still is, I mean, it still is reliant on technologies in the US and, ASML. But, China, I think people tend to underestimate how quickly China can catch up in terms of technology. So, I think there were some predictions that China would take at least a decade to come up with technologies that are similar in the US now. But I think that there's a risk that people might be underestimating the capabilities that China has, especially when you have a government that's incredibly determined to make itself competitive in this space. It's a matter of national security, like it is in the US. So what we're seeing is the government is funneling an enormous amount of funds towards developing these technologies. The idea is also, I mean, you're killing two birds with one stone, right? You're fixing the youth unemployment by also essentially saying this is an industry that we prioritize. So, go into this industry essentially. And what Beijing is doing is also trying to rally the private sector in terms of investment and trying to get investment into these kind of technologies because, as you just said, there is a reluctance from foreign capital to go into China, and all the VC money that went into China tech over the past decades was completely killed by what Beijing did when it came to the crackdown on Alibaba, on Tencent, and all those other big companies. Well, the education technology sector specifically as well. There was a lot of VC money behind that and private equity money behind that as well. So it's unlikely that kind of money, foreign money, will want to, first of all, invest when they've been really they've lost a lot of money in recent years, but also there's a political angle there, right? Are you going to convince foreign investors to invest in technologies that will be used essentially to compete against the US? There's a problem there on, is China going to use this for military purposes? What is AI going to be used for? What are advanced chip making capabilities going to be used for? If it's a matter of national security as well, how do you divide kind of the foreign investor interests with what the government is trying to achieve? So I think it'll be quite difficult. There is a lot of money in China. Closed capital account, returns in the property market are not good. Investing in startups seems to be the way to go, at least from what Beijing was telling people to do. And also Beijing has a little bit more power in directing capital than most governments do. It's not just subsidies, it's essentially saying, hey, this is a priority for us, so invest. So to kind of sum it up for anyone just tuning in now, China is behind when it comes to AI tech and chip making capabilities. There's absolutely no doubt about that. But I do think that people are underestimating how quickly it can catch up.
One of the narratives for the last year and a half or so was that we're in a cycle of deglobalization, friendshoring, and we're going to try to have less reliance on China given supply chain disruptions that we saw post-COVID. Has any of that really happened, or was a lot of that just talk?
I think that's already happening. You're already seeing, for example, TSMC increasing its capabilities is it Texas that they have the plant? It's obvious that there is, what's the word that people are using out? De-risking. I think was it Macron who said this week that de-risking from China doesn't mean that China is a risk, which I thought was a brilliant diplomatic way of putting it. But there is, it makes sense, not just, yes, you do have supply chain disruptions. We saw how damaging that could be during the pandemic. I don't think people are doing this because there's a concern that we're suddenly going to have another pandemic, or, borders are going to shut, or China's going to go to war and, shut itself off from the global supply chain. But it's also, it works well politically, right? It's kind of in the US, it's made in America. In the UK and in Europe, it's, let's focus on innovating, on really reviving our economies, on getting, investing in our own companies, trying to not be so reliant on technologies from elsewhere, but, trying to be a bit more competitive with the rest of the world. So I think that's a really important conversation. I mean, I'm sitting in London now and I am European, and there's a massive productivity issue here, right? So how do you kind of improve that and solve that problem from the government perspective is not just let's expand globalization and essentially rely on other countries to supply what we need at a cheaper level. It's really, the focus is on how can we be a more competitive, productive economy? Let's invest in that. So I do think there's so many elements to this right now. And it's really interesting how far the conversation has gone from globalization is good to actually let's invest in our own technologies, our own infrastructures. And people seem willing to pay a higher price for that as well. There's obviously a premium to that. But I mean, so far in earnings season, pricing power doesn't seem to be an issue for the companies that do it well. So I think also that's giving this a bit of a tailwind.
Some of the audience.
I think that's a really good question. I think first people need to understand that the China of the past few decades no longer exists. And, double-digit growth is not the China of the future. I assume that you're talking about the economy here. What China is trying to do is incredibly hard, which is pivot a very manufacturing, export-driven economy into, and property market that's been a huge driver of GDP growth, into a consumer, more advanced economy that has, high tech rather than just spending on infrastructure and building more bridges. I think, just put it simplistically, there aren't really that many more bridges and airports that China can build on the kind of big infrastructure project side. From a top-down level, that was actually a problem during COVID when the government was selling trillions of yuan worth of bonds to invest in infrastructure projects, and governments just couldn't find the projects to invest in. They had all this money and didn't deploy it, which is why we saw growth slow. So I do think that China's trying to do something very quickly that most economies took a much longer time to do, which is to pivot the source of growth. I think what people are getting wrong is they think that China has that this has come crashing down on Beijing and Beijing didn't know that this was coming. I think that's really underestimating the capabilities of the government in Beijing. It's not, the property market downturn it was engineered by policies in Beijing. It's not China shooting itself in the foot. The fact that China is not right now, and I get a lot of these questions, even now, why is there no helicopter money in China? Why doesn't China just do the fiscal transfer to consumers and give everyone spending checks and be done with it and finally get the consumer spending again? There are concerns, long-term concerns, sustainability concerns that China has very much front of mind. And a lot of that actually, and just kind of speaking to the theme of this space is the shades of the summer crash, it has to do with recent history and the policies that China chose in the wake of the global financial crisis, which was essentially to print money, to take on a lot of leverage, a lot of debt to boost the economy. And it really overheated, and now it's dealing with the fallout. So reducing financial risk is a big priority. And I think what people may be getting wrong is how much pain China is willing to stomach, economic pain in the short term versus, to achieve those long-term goals. And again, to what I said a few minutes ago to Michael, the short term for China is a lot more long term than it is for most people. So for China, 5 years is short term, which is, an eternity for governments who have to deal with election cycles. So, when we think about that, if China can stomach this amount of pain in 5 years to try to kind of re-engineer a sustainable level of growth that's not just based on leverage, not just based on debt, but actual demand, real demand, domestic demand, then if we do get 5% growth in the next decade, what someone called an L-shaped recovery, would that be a more productive way to kind of focus on growth in the long term? So again, I think people underestimate the capacity of China to look long term and to kind of plan long term. And what I think China underestimates is the impact that its policies have on its residents long term as well. So there's a tricky balance there. I hope I answered your question. Just to clarify, devaluing the currency? Oh, well, The yuan is a very tightly managed currency. The idea that the yuan is free flow, it's really not. And this has been something, when I was covering Chinese markets in Hong Kong, every single year there would be someone who would say the yuan is a potential, the internationalization. I find that word really hard to say. Internationalization of the yuan is coming, and the currency could be an alternative to the dollar as a global currency. That's never going to happen, or at least, I can't say never, but it's not going to happen anytime soon. It's a very tightly managed currency. It can only move 2% either way of the fixing every single day. The PBOC makes no secret about that. It does intervene in the currency market, and it has been doing that actually recently. It guides state banks to either buy or sell dollars to kind of move the currency, make sure it's stable. I mean, China devalued the yuan in 2015, and it did that because, yes, the yuan was overvalued, but it did that in a way that was so poorly communicated that it ended up massively backfiring. It also came at the same year that the stock market bubble collapsed, and it was just a terrible year for China generally. But what happened was it undermined investor confidence in China. It meant that more than 1 trillion yuan in capital outflows, more than 1 trillion yuan left the country because of that. And you don't want that, right? You don't want to suddenly devalue a currency. I know emerging markets do that all the time, but it's financial stability. Again, to my point earlier, financial stability is the key priority. And, we can see maybe a slow managed depreciation rather than devaluation of the currency, which makes sense if you're going to stay competitive, if your exports are going to stay competitive. But in the long term, China doesn't really want to rely on export growth as the driver of GDP. What was happening actually earlier this year and last year, at the end of last year, was the yen was tumbling so quickly that all these countries in Asia were suddenly, thinking, actually, we have to manage our currencies lower. It was almost a race to the bottom, triggered by what Japan was doing. But I think that China has learned from its mistakes in 2015. And if it's going to devalue the currency, is going to do so very slowly, communicate it very well, and it will make sense. They tend to do it actually when the dollar is strengthening, because that obviously gives it a lot more room to do so, and it allows the PBOC to manage currency weakness kind of stealthily. So I think that could be quite interesting if we do get some dollar strength. Michael, do you think we'll get some dollar strength?
I think if I'm right that you have a credit event, you will. First of all, I have Jason Shapiro, who's in the Unknown Market Wizard series, and he had noted that the CFTC positioning is highly short the dollar. So anyway, I'd argue there's a short squeeze coming in the dollar. But if you have any kind of classic risk off, which I think we now may finally be in, although again, it's a question mark how treasuries respond in this. Yeah, the dollar probably does what it did last year, right? Where ironically, the dollar was the best inflation hedge. Maybe that kind of kicks back in. And actually, I'm glad that point was made, because I did want to ask about the interaction with the currency side there.
Well, we've already seen China it's really interesting actually to see China strike trade deals with certain countries in yuan, where trade is essentially settled in the Chinese currency rather than, the dollar or other more global, more kind of widely used currencies. You mentioned Russia. I think everyone knows that's the obvious one. Brazil has been a close ally of China. A lot of countries in Africa as well. I'm not going to pretend I'm an expert on this, on, where China is kind of going next in its trade deals. But, at the end of the day, it's the world's second largest economy. It's heavily entwined with global trade. So most countries have to deal with China some way or another. I think the de-risking narratives suggests that I think we need to be careful here. It's not the case that people will stop trading with China. It's more that they'll continue to pursue that relationship, but in a way that's not so kind of blind or so reliant on policies in China and what happens in China, but kind of gain back that control. I don't think I answered your question there. I'm not an expert on geopolitical relations and where China is going next. I do think the narrative, though, around how you interact with China is changing. And countries in the Western world, and when I say Western world, I mean Europe and the US, want to make sure that they're engaging with China in a way that they can control a lot more than they did in the aftermath of China essentially joining the WTO and being by far the biggest beneficiary of globalization.
I am curious if I mean, sure, I assume maybe that you have analytics on, writings that you're putting out and content in general. I once hosted, or co-hosted, I should say, Bloomberg Rewind with Matt Miller many years ago. This is like in 2011, 2012. And I had asked him off air during a commercial break, how are readings at Bloomberg? And his response was, well, readings correlate to the VIX. And of course I smiled, right?
That's great.
Right. And we all know what that means, right? And of course I smiled. I said, does that mean that financial media has an incentive, right, to maybe cause a little bit of fear, have a little bit more of a negative narrative because that's what gets the eyeballs and eardrums. And then of course, commercial break ended. Oh, we're back here with Michael Guyad. So he never really answered the question, but I always reference that as an example because is there any sort of element of truth that there's some bias in financial media? I mean, you can definitely argue that with mainstream media, but is there any kind of bias, when it comes to financial media in terms of covering market movement?
This is really interesting. I was actually having this conversation with my partner the other day. I think it's a fine line. Is there more demand for news when things are bad? Or does news feed that demand? Like, which one is the driving force here? My counter to Matt Miller's VIX analogy is that actually, and I'm not nowhere near up, far up the value chain to know our numbers, but I know just anecdotally that there was an enormous amount of demand for financial news during the meme stock era, the pandemic bubbles that, we saw in crypto. And that's when the markets were going up, right? So it's not just fear. It's when there is a kind of collective mentality in the market. I think that, and just, from my own perspective, when things are going badly and when markets are crashing, you tend to want more news. You tend to want to know what the hell is going on, right? And when things are stable, when things are predictable, when you can essentially, if you're a portfolio manager, you can go on holiday for 2 weeks and come back and everything's exactly as it was. You're not going to really want to read news. There's, you feel good. You feel good about where you are. You're not panicking. I think financial news just generally tends to kind of hit that demand or feed into that demand more when people are panicking because we feel a responsibility to try to explain things. What is going on? Is this going to last? What does this mean? There are just so many more questions that people are asking when there's fear in the market. When there's joy in the market, no one cares. No one needs an explanation for why they're making money. So I think you can kind of blame the demand side of things. I don't think financial news is blameless, obviously, but there is a demand side to this as well, right? People wouldn't be writing articles, first of all, about things that are not happening. And second of all, that people wouldn't want to read. So it's, it is both things. I think there's a lot more negativity generally right now. And, you can blame social media for it. You can blame just, I don't know, people just feeling worse about the future, people not being able to own. Well, here in the UK, I don't know if any British people are listening to this right now, but I think people like to complain and pessimism is a lot more fashionable than optimism. But I think financial news media has a responsibility to report the facts. And if the facts are markets are crashing, we should report that. If the facts are markets are joyful and bubbly, we should report that as well. The thing is, when markets are just kind of creeping higher and doing exactly what they're meant to do, how do you write a headline? How do you write a lead? How do you pitch a story on something just doing exactly as it is expected to do? And I think that's a difficult thing to do. And I think an important one, Michael, but I think that problem still hasn't been solved.
And the conversation goes full circle because the only way to write a headline like that is to be annoying. like me in the content that I put out, because to your point, writing about something that's not happening, the only way to get people to pay attention is to be loud. At least that's always been sort of my approach. I say that, of course, tongue in cheek as I'm smiling, thinking about how we've kind of gone a little bit full circle here. Everybody, please make sure you follow Sofia here on Twitter, and hopefully I will see you all later. And hopefully it's not the end of the world yet, because I promise you that if I'm right about a credit event and if we are in it, at some point, the end of the world will be the bull case. So thank you, Sophia. I appreciate it.
Thank you.